Welcome back to Golden Rule Radio. We have gold still in the range between 1300 and the previous high of 1375. We have the dollar still flirting around the 88 to 90 range. And I think the markets from last week, what we said, the markets are still kind of trying to figure out which way to go from here. I think it is at a crucial point with the dollar index. We're also going to touch on the new Fed chairman Powell's comments and the effects that that had in the market and the effects that we think that it will have. So let's start with gold.
Well, Robert, you mentioned that we're bouncing between this 1375 and 1300 really, and we are right at about 1317 today, but that's with a significant drop in the last two trading days due to partly the Fed comments that we'll get to. But Miles, showing that chart, I mean, that's, to me, still we're in very strong bullish territory.
Yeah, you have to look at the chart as a whole. I mean, the ups and downs on any given day or week. You look at the gold chart since the bottom in 2016. Obviously, we're compressing up towards that 1375. I don't know how much resistance we're actually going to see there, because if you stretch the chart out a little bit more, we've even got quite a stronger point coming up around 1400, 1395, 1400. Numbers we haven't seen since like 2013, 2014. So it should be a pretty fascinating year for gold as we finally get up to that 1375 high and push beyond it. I'm still putting my year-end targets in the low to mid 1400s at least, making the assumption that Dow Jones maintains a little bit of strength here, the dollar maintains a little bit of strength in normal trading. Now, if any of that changes, if we continue the slide in the Dow or the dollar or both, can you imagine a world where they're both going down at the same time? Well, then it's off to the races for metals like gold and other commodities like oil and natural gas.
Okay, Miles. Well, turning to silver. Silver's in a compressing pennant. Why don't we talk about that?
It also is awaiting breakout. And the more this pennant compresses, the more it's trying to tell us that it's either going to break out to the upside or to the downside. And we are sitting here watching anxiously to see exactly which direction it goes. We also had a price drop along with gold immediately following the Fed chairman's comments. And, don't get too wrapped up in the microcycles. Miles does such a great job on this show of showing you more of the macro picture.
Yeah, the other white metals are following suit with silver. Silver's compressing down. We're going to see that breakout. Platinum is doing the same. Platinum's been trading sideways, not in compression, but just highs and lows over the last year or so. And palladium, even though this year it's taken a pretty big dive off after the big run-up we had last year, palladium's actually come up about half what it's lost here over the last couple weeks. So all of the metals, I believe, are showing strength. Outside of silver compressing downwards, which there's really no way to know which way that breakout will take place when it does, both platinum and palladium are at the high end of their trading ranges right now, and I think platinum is still showing great strength.
So looking at these charts, please listen to what we're saying as well. We are not ruling out a further decline. We're not saying that 1300 to 1370 is set in stone. As we've said the last few weeks, 1285 is still a real possibility. So any opportunity to step into the market on those declines, we're going to take advantage of.
Moving on to the dollar, we touched on how the dollar was the crucial market to follow the DXY because it is going to show, I think, what the next major trend in most other markets will be.
Yeah, and Tori, you bring up a good point about gold possibly coming down to 1285. I know for the last couple weeks, Robert's been talking about the dollar after this big drop, maybe pushing up into the 91, 92 level. Yep. We got a nice kick up from Powell yesterday.
He showed some confidence.
He did, and the only reason that it's not higher is because of the fact that it actually had dropped in the morning, and we were starting back down again below that 89 level, and so actually the turnaround was strong. But Robert, your prediction of us seeing 91, maybe 92, that does put gold around 1285.
Well, and the dollar coming up strong too caused the Dow to drop about 800 points over Tuesday and Wednesday this week.
I want to see more data. I want to see more of where the dollar goes and some other markets go before trying to make a decision on which direction all these markets are going to head after this kind of temporary pause in the markets I would say we're in.
You're not alone in that. I think that's exactly what these charts are saying, right? Everybody wants to get more data.
I'd agree.
And breakouts we will see. We're coming up against some seasonal issues as well, so keep that in mind. But that U.S. dollar is really just an unknown at this point.
So moving on to the equities markets, we had the equities markets close at a session low on Tuesday when Powell was talking, which I think is pretty significant because it was down a little bit, up a little bit, down, up, and then closed at the session low.
Yeah, actually, that volatility was huge. I added it up. I mean, if you just go in 50-point increments, it was about a 700-point swing from start to finish of when he started talking to when he finished talking. That is volatility. It's amazing to me, the power of the words and how it can move markets.
It is, and I think you're going to have some performance gaming going on throughout this week, and then we will see where the markets want to go from there. But what else do you want to say about the equities markets?
The equities market is telling quite the story over the last couple years. I mean, we look back to the market highs back in 2015, 2016, when ultimately I initially thought we were going to have a rollover.
Because it looked like that.
And then lo and behold, at the beginning of 2016, somewhere some money showed up from who knows where, and we get about a 1,000-point rise in the equities market over the last couple of years. So it wouldn't surprise me at all to see, let's say, all of that disappear. So the question would be, how does that happen? What does that look like? Because we've been talking about the Dow rolling over for a year now. In fact, we've been talking about the Dow rolling over for the last couple years now. So when you go back and you look at a couple points on the chart, just in the short term, just from the real kick up in pricing at the end of 2016 until we spiked out just a little under 27,000, you look at some Fibonacci levels there. Granted, we had a pretty big drop here so far in 2018. About 3,200 points, I think, in the Dow over the course of about 2 weeks. And I'm always amazed when reality lines up with technical numbers. And you see that this drop came right into your first fib level at the 382. So it doesn't surprise me we've had a kick up from there as the Dow has turned back up. So right now the story is, which way is it going to go? Is the Fed going to be able to continue to pump money in and stretch the growth out in the Dow? Or is the market as a whole going to start taking profits and getting out at this point? So if we stretch that picture out a little bit and just look at the bottom in 2016 to the top this past year in December, you'll see that some of the Fibonacci levels on this medium turn end up lining up with the levels from the short term we just looked at. So I think you've got some pretty important numbers here on the Dow at around 22,003 to 21,200. I think that those are some definite figures we could see if the Dow continues down. And then ultimately, and this was just fun for me, looking back at the very long-term chart and getting back to the 2007, 2008, 2009 collapse that we had in the Dow that we all remember, lo and behold, if you take the low point in 2009 and the high point in 2017, the 618 fib lines up exactly where the market had topped out at 14,000 before the previous crash. So to come back and erase all of those gains from 14,000 up to 27,000 would just be considered a normal, healthy correction by technical standards.
Well, I know that there is concern in the market because I've received calls from clients and some new people who haven't gotten into the metals market yet. I've received calls with people wanting to reallocate out of equities and into metals. And whether the equities market has peaked, we won't know yet, but it very likely could have, but maybe it didn't. And maybe it'll go higher, go marching higher into, a brave new world like it seems like we're in. But I have had some interest with people trying to get out of the equities market and saying, I've had enough, I've had good gains, I think the sea change is upon us, it's afoot, and here we are, let's move. I'm good with where we are with my stock portfolio. I want to exit stage left. I want to get off the train tracks before the freight train runs over me. You don't know how far out that freight train is, but it's definitely there. And so we've had people calling, asking about that. And I think that's a sign of people's concern. Some people, I'm sure, are saying, oh, that's foolish, stay in. But we do have some people saying, oh, you know what? I'm good with this. I'm getting off the train tracks, so to speak, with the equities market.
Yeah, it doesn't mean you have to exit it completely, right? You can be wise.
Right.
You can be doing your homework, and you can be saying, look, I'm going to trim this position, and I'm going to fatten this one over here. And that's a lot of what I'm seeing too, Robert. A lot of IRAs moving now, at least a portion of those retirement accounts into the physical metals. And it's not because we're out there advertising and convincing people. They're calling us because they know that train is coming.
It's cyclical, like the markets are, and like a lot of things in life are. And people are realizing, well, we've had a big cycle on one side. We've had kind of a pathetic cycle with the metals market in the last few years, but slowly in the last couple, the metals have been constructive. Gold's been making higher lows, a little bit higher highs. So everything's been constructive. So that sea change that we're talking about, whether we're in it, in the middle of it, and we just don't know it yet, or if it's coming in the next year or so, people are starting to reallocate. And I would say that's a pretty good move.
The Federal Reserve is trying to stay on its toes too, right? They're in the middle of it. Nobody's more in the middle of it than the Federal Reserve, to Miles's point, with all this funny money coming into the system and propping up the markets. But that being said, Powell is talking about inflation. He's talking about wages. He's talking about a red-hot economy running rampant, right? All of these fundamentals that he really has to be watching on his watch. He's got to be monitoring. And he even mentions, the debt ceiling being raised in timely fashion. So all of these things tell me, yes, he is watching very closely. He's right in the mix. It's what is creating all this volatility and uncertainty in the market, because at the same time he's saying all that, he's also saying he doesn't know. They don't know either, Robert. And will there be 3 rate hikes? Sounds like that's a pretty sure bet. Will there be 4? Possibly. But again, the concern that he's pointing to is inflation. If we see strong inflation, you will see the white metals follow suit. If we see a red-hot economy and wages are really running rampant, they will raise rates 3, maybe 4 times. It's not going to slow down the precious metals.
So the left side of his mouth is saying rate hikes. The right side of his mouth is saying, oh yeah, we'll raise the debt ceiling if we have to. And the middle of his mouth is at least admitting they have no idea.
That's right.
Last thing on Powell and the U.S. dollar worth looking at is the Treasury yields, which we can throw a chart up. If you watch just the minutes as Powell was talking and you look at the 10-year Treasury just leap into the sky as he was speaking yesterday. So we're seeing those Treasury yields pushing up, which is obviously pretty detrimental to people who are sitting in those bond positions already. And I would argue scaring off potential bond investors, since we're still in the early stages of interest rates rising and yields rising. Why would you want to lock in a bond price if you're not already in at 2.5% or 3%? What if it goes to 6 or 7 or 15, like we might have seen back in the 80s?
Well, and don't discount the effect that that's going to have on home sales, right? January saw pending home sales crash the most since 2010. Don't you think that short-term interest rate hikes are absolutely going to have a negative effect on the housing market?
Well, and I saw a couple tweets on Powell's speech talking about he has no intention of capping mortgage-backed securities either.
Well, and then he turns around and he mentions the fact that when you have aggressive rate hike policy like that, it almost always leads to a recession. So get ready for that. Just because you have inflation does not necessarily mean that the economy has to run rampant. If the Fed acts the way that they're talking they might, be prepared for that downturn. It will impact the equities. It will impact the general economy.
So all of this left, right, and middle out of his mouth explains a lot as to why we're seeing the prices bouncing up and down in the Dow. We're seeing the volatility index take off like we haven't seen in a number of years. We're seeing all commodity prices rising over the last year or two, and we're seeing the dollar declining. Nobody knows what's going to happen. And when you don't know what's going to happen, you can assume it's more likely to be negative than positive. Knowing bad news is better than not knowing anything. And the market doesn't know what's going on right now.
Before we wrap this up too, just remember the Federal Reserve has a job to do, and they would much rather see inflation. Okay, what he said yesterday is that inflation is moving upwards towards their target. Okay, but they are talking about increased rate hikes beyond that, because they don't want inflation to run too loose, right? So deflation picture is a dead horse. Inflation is a horse running loose. You can always rein in that wild horse. You can't revive a dead horse. They want inflation. They just are saying that they can control it.
We've sent out a few emails in the last month, and if you're not on our email list and would like to be, you can call us at 800-525-9556. We'll be continuing to send emails and action items, so get on our email list.
Thanks again for listening this week to Golden Rule Radio. As always, click subscribe, ring bells, go to Twitter at ICA Gold. Check us out at McElvaneyICA.com, or as Robert mentioned, give us a call anytime at 1-800-525-9556. 9556.
Thanks for listening. Have a great week.